Hello everyone, I hope you guys are doing well and studies are going in full swing. Now, in the preparations for your May 25 exams, and even if your exams are thereafter, there is an important change which the institute had done in pertinently 3 important questions in your study material. So what we will do is in today's video, we'll quickly run you through those 3 questions as well as the relevant changes which are there. Now, we are not going to go into that part whether what change the institute has done is correct or not, what should have been ideally the case. This is the latest study material that the institute has issued and they've made certain updates on this. And if the same questions invariably land up in your exams, you will do the treatment as what the institute's study material suggests. That is certain to give you your marks. Though I do believe that since the changes were made relatively late, they would also give you alternative marks for treatment, which was done as per the older methods as well. But nevertheless, we'll keep it quick, crisp, and relevant from your exam perspective. So the 3 relevant places where there is a change is first in Ind AS 20 on government grants. The question over here involves a grant where the collection may not be probable. There were 2 possibilities. Even earlier, we had said that the second possibility was not done properly. Thankfully, the institute has updated it, though a little late, but better late than never. So we'll discuss that one. Second, in case of deferred taxes and share-based payment, well, largely the working remains same. However, they've tried to interchange the numbers between carrying value and tax base. And if that question comes invariably in the exam, do it the way institute does. Ultimately, your answers, etc., do remain the same. And third is where they've changed the question as well as solution for customer loyalty points question, which is there in your Ind AS 115 revenue recognition. So let us get started. We will share the PDF for these also on the Telegram channel, so you can get access from that. But otherwise, if you quickly review the video, you should be exactly clear with the changes which are there. So over here, this is Ind AS 20 practice question number 2 in your study material. In our books, I think this is question number 9 of your benchmarks books. So over here, this was a question where entity A awarded a government contract of 60,000, which was receivable over 3 years, 40,000 in year 1, 10,000 in year 2 and 3 respectively. So this is money received over 3 years, contingent on creating 10 new jobs and maintaining them for 3 years. So this is contingent on creating jobs and maintaining them. This is not linked to acquisition of an asset, so it is linked to a grant, which is linked to income. Employees are recruited at a total cost of 30,000 and the wage bill for the first year is 1 lakh, rising by 10,000 in each of the subsequent years. So your cost will be in year 1 a total of 1 lakh 30, that is 30 plus 1 lakh. In year 2, 1 lakh 10, and in year 3, 1 lakh 20. No changes over here. Calculate the grant income and deferred income to be accounted in the books in the years 1 to 3 under the following 2 situations. First is a reasonable assurance that the company will comply with the conditions attached to the grant and the grant will be received. So over here, there is no change. The solution remains exactly the same. Just as a quick referencer, if the conditions are expected to be satisfied, then your entire grant income, that is 60,000, will be deferred over the 3 years in the ratio of, so this is 60 into 13 by 36, 60 into 11 by 36, and 60 into 12 by 36. So there is no change over here, and 60,000 minus whatever is a grant income amortized will be taken as a balance in the deferred grant account. So as you see over here, this is 60,000 into these numbers. This will give you the grant income to be recognized in each year, and then the deferred grant balance, 0 changes over here. This was done correctly earlier. It is still correctly applied. The change over here, we'll highlight this, is if there's no reasonable assurance that the grant will be received. Now earlier what the institute used to do was, it would do the working considering a different base for grant income amortization and a different base for deferred income working, and hence this was internally inconsistent. But as it was done earlier, we would have recorded it that ways only. However, now the institute has updated the solution to reflect the correct workings. That is, if there is no reasonable assurance that the grant will be received, then you will record the grant income based on only what is actually received. So in the first year, 40,000 is received, and as a result, we will say that, well, other 10 and 10, we are not very sure whether that is going to be received or not, and hence in year 1, what you will record is 40,000 into, let us say, 130 divided by 360. So that is your total. So this is 40,000 into 130 divided by 360. and hence this will come to around 14,444 or 45 as the case may be. So this is your grant to be recorded as an income in the first year. Now, if this is your grant income, what is the balance in the deferred grant account? Well, we will say that 40,000 is correctly the balance minus 14,444 is recorded, and hence you will have 25,556 to be the balance in the deferred grant account, and that is correctly done. 14,445 they have done, and 25,555 is the balance to be recorded in the first year. Now, when you go to the second year, 10,000 is further received, but that certainty was not there in the first year, and hence that 10,000 has to be spread over year 2 and 3 only. So when you look at grant income for year 2, you will say that 40,000 which was received in the first year into, let us say, 110 by 360, that should be recorded. A further 10,000 is received, but this is received in the second year, into 110 upon, I think, 230, which is nothing but the total of 110 and 120. And as a result, if I go to see 40,000 into 110 upon 130 will come to around, I think, just a second, 40,000 into 110 upon 360 will come to 12,222, as you can see over here, and 10,000 into 110 upon 230 will come to 4783, as you can see over here, and hence the total over here will be around 17. Over here the total will be 12,222 plus 4783. This comes to 17,005 approximately. Now, if I have to calculate the deferred grant balance, this is your income, but your deferred grant balance, if I have to calculate, well, 40,000 was received plus another 10,000 was received. So this is a total income with the total amount that is being received, out of which 14,445 has been recorded in the first year, and now 17,005 to be recorded in the second year. So if I go to see, this comes to what? Well, this is, I believe, 18,550, which is correctly recorded as deferred grant balance. And then when you go to the last year, then whatever is remaining, like in the third year, another 10,000 is received. Now I cannot retrospectively go back and record the 10,000 earlier. However, I will do record that entire 10,000 in the third year. Apart from that, the 10,000 that was received in the second year, out of which 4783 was recorded earlier, the remaining 5217 will be recorded now. And the 40,000 that was recorded, out of which 14 and 12 was recorded, another 13,333 will be recorded, and thereby the balance in the deferred grant will actually become zero. This is exactly how it should have happened. This is exactly how the institute has done it. There could have been alternative allocation methods which can be possible, but this is the method which the institute has done. I believe that this is a reasonable method, and hence if it comes in the exam, go for it and do it this way. Though I do believe that even if you solve it by an earlier method, because in the exam also that had come, they should give you credit if you kind of miss this, but this is more logical, and hence if you practice this once and even listen to this 5 to 10 minutes clip, you should be able to get that with one set of practice, nothing to worry. Second is your illustration number 5 of Ind AS 12. Now this is pertaining to share-based payment. Now logically, when there was a share-based payment, the steps that we had taken is that over here, the first step is a carrying value. Now, as per Ind AS, the carrying value is based on the fair value. Fair value is usually not taken as the base for deduction in income tax, and hence earlier we used to say that the carrying value will be taken as nil. However, the tax base will be the deduction that you can claim at a later date, and that will be based on the intrinsic value. So, proportionately recording the intrinsic value would have ideally been the tax base. Now, the change that the institute has done over here is they have taken in your deferred tax calculation your carrying value to be the intrinsic value, not the fair value, intrinsic value into the pro rata working, whereas the tax base they have taken as nil. So whether this is right or wrong, again, this is debatable, but the institute has done this small change. So if it comes in the exam, you might as well do this. Sir, but aage that will mean things will change. No, earlier also we had said that this is a deferred tax asset. Still it is a deferred tax asset. Why? Because logically, the standard over here believes that income tax will give you deduction in the later years when the options will be exercised. And if income tax is giving you deduction later, that will result in a deductible temporary difference and thereby a deferred tax asset. And even over here, there's a deferred tax asset. So the only difference over here is in the carrying value and tax base, where the numbers are interchanged, whether that is a printing mistake, typo, or a conscious change. Well, that institute only can say, but if it comes in the exam, just make this small change and you are good to go. Like over here in question 1, 1st April 11, P had granted 1 crore share options with a fair value of 4 crores. This will not be considered for the purpose of deferred tax working. Subject to a 2-year vesting period. The income tax law permits deduction on exercise date, that is at a later date, so there's a timing difference, but based on the intrinsic value of the options. The intrinsic value on 31st March 12 was 1.6 crores. However, this is just 1 year gone by, and at 31st March 13 was 4.6 crores. This is after 2 years. The increase in the fair value of the options was not foreseeable earlier, and the options were exercised on 31st March 13, which means there is nothing outstanding. Your carrying value as well as the tax base will become 0 as on 31st March 13. Give the accounting treatment for the transaction for the year 31st March 12. And 13, assume that there are sufficient taxable profits through which you can create a deferred tax asset and the tax rate is 30%. So over here, as per the revised treatment, usually we would have taken the carrying value to be nil. Now the carrying value is the intrinsic value, that is 1.6 into 1 by 2, and hence the carrying value is taken as 0.8. But the tax base over here is taken as nil, because in income tax they are saying that there will be no entry. So fair enough, tax base is taken as nil. And hence the difference is still 0.8 crores. This is a difference where income tax is going to give you deduction at a later date. And if income tax is going to give you deduction at a later date, that will create a deferred tax asset. So this is still a deferred tax asset. Your entry is DTA account debit to the profit and loss account, that is 0.24. The next year, because the options are exercised on 31st March 13, the carrying value is nil, the tax base is also nil, and hence the difference is 0. If the difference is 0 over here, you'll have to reverse the deferred tax asset created, and hence it will be P&L account debit to deferred tax asset. So this is P&L account debit to deferred tax asset, and that is about it. And then you have this question on Ind AS 115. So you're done with these two questions. Then you have this question on Ind AS 115. I've highlighted the places where there is a difference and also tried to solve this separately in a way which is a little more easily understandable, the way we usually do it. So I'll share the board note for this also for you, for your separate reference on the Telegram channel. So what is happening over here is this is quite a popular question, and here Institute has made certain changes. Again, in my opinion, there are certain flaws in the language still, based on which the question and the solution do not logically reconcile. But if we have to focus on what is to be done with the exam, if a similar question with similar language, amended language comes, then this is what you need to do. Remember, in question number in the questions of Ind AS 20 as well as Ind AS 12, there was no change in the language of the question. They've discreetly changed the solution. However, over here, they've changed the question also and the solution also. Though there needs to be a little more clarity, I think, in the language of the question, in my limited understanding. But again, that is not a point of discussion here. KK Limited runs a departmental store which awards 10 points for every purchase of 500, which can be discounted by the customers for further shopping with the same merchant. So that is fine. 500 rupees worth of shopping gives you 10 points. Earlier also this was the same. Unutilized points will lapse on expiry of 2 years from the date of the credit. So I think this is the total validity. The value of each point is 0.5. And for the accounting year 11-12, the entity awarded 1 crore points to the various customers, out of which they say 18 lakh points remain undiscounted. Now this is a little contentious in my understanding, but let us review. This is the new language that they've added. The management expects only 80% of the total award points during the year will be discounted, of which normally 60 to 70% are redeemed during the next year. Now, earlier, if you see the institute's language of the earlier problem, they had said at the end of the year, the management expects that 80% of the points will be redeemed. So, which means at the start, the management did not think at the start that only 80% of the points will be redeemed. However, here the language changes to say that the management expects, in general, they don't say that this is your expectation at the end of the first year. Like the question which was earlier there, which might be there in your books as well, or your old study materials. Here they say the management expects only 80% of the total award points during the year will be discounted. So out of whatever is the points that are getting granted, only 80% of those points are likely to be discounted. And hence when you find the fair value, you have to consider the probability based on the points that are likely to be discounted and do the workings. Okay, the company has approached your firm for queries and asked you to do SG accounting treatment under the applicable Ind AS for these points. First, how should be the recognition done for goods worth 10 lakhs sold on a particular date? So when I am selling the goods as an entity, I have two obligations. One, to deliver the goods. Second, to deliver the points. Now, goods over here will result in recognition of revenue, whereas points are like credit notes. And hence, I'm giving you points which you can use for taking goods at a later date. And as a result, we will create, as we have discussed earlier, a customer loyalty point or a CLP liability. There is absolutely no change over here. There will be two performance obligations. If you see over here, your performance obligation number 1 will be goods. Performance obligation number 2 will be points. So when you look at goods, you will allocate the transaction price between the performance obligation and the ratio of the standalone selling price. So when I look at the transaction price, well, for both of them together, the customer is still going to pay you 10 lakh rupees only. So that is your transaction price. However, that will be allocated between the goods and the points in the ratio of the standalone selling price. So had there been no points, still the standalone selling price of the goods was 10 lakhs. So there is no change over here. However, for the points, well, for 10 lakhs worth of shopping divided by 500, that is 10 lakhs divided by 500, that is 2000 into 10, that is 20,000 points will be given. Now each point is worth 50 paise. So this is 20,000 points into 50 paise, and hence this comes technically to 10,000, which was the case earlier. However, earlier the management did not expect in the earlier problems that only 80% of the points will be redeemed from the very first day. Now the management is expecting in general, whatever points are given, only 80% of those points will be redeemed. And hence, this entire number into 80%, the things that I've written in blue are the things that are changed. So over here, this is into 80%, and hence the standalone value of these points would actually be 8,000. So if I had to allocate the total transaction price of 10 lakhs in the ratio of the standalone selling price, that is in the ratio of 10 lakhs, is to 8,000, and hence this is 10 lakhs into 10 lakh by 10 lakh 8,000, 10 lakhs into 8,000 upon 10 lakh 8,000, and hence your allocation comes to 9,92,000 for the goods and approximately 7,937 for the points. Your entry will be bank account debit from the customer. I've received 10 lakhs. 2, I've discharged my performance obligation on the goods. So 2 sales at 9,92,000 and 2 CLP liability. Why am I creating a liability? This is like a deferred revenue account because I'm giving you a credit note like a point, which at a later date you will come, you'll redeem the point. I'll have to give you the goods, but you will not give me the money. These are points. And as a result, I'm saying that the customer is paying me today for the goods that I'm delivering today as well as at a later date. But revenue I can only recognize for the goods that are delivered today, which is 9,92,000. For the remaining, I'll record a deferred revenue or a customer loyalty point CLP liability at 7,937. So this is the first thing. That 80% thing is the point which there's a difference. Second, you have how should the redemption transaction be recorded in the year 11-12. The company has requested you to present the sale of goods and redemption as independent transaction, and the sales are 5,000 lakhs. Now, in the institute solution, which is given over here, they've done everything in full numbers. I've just done this in lakhs because at a concept level, you should be clear. Those big numbers tend to intimidate you a little. So over here, if these are goods worth 5,000 lakhs which are sold, the transaction price, the customer is going to pay you a total of 5,000 lakhs. That is for the goods and for the points. The standalone price of the goods are 5,000 lakhs only, but for the points, this will be how much? Well, if I take this, this will be 5,000 upon 500 into 10, that is 100 lakh or 1 crore points as given in the question, each point being worth 0.5, and hence this is actually worth 50 lakhs. However, again, I've written this in blue. 80% is my expectation of the points that will actually be redeemed and utilized, and hence the fair value should consider that, and hence this is into 80%. We did not take that earlier in our sum that was solved because the question I told you at the end of year 1 the management estimates, and hence that was based on the remaining points. Here this is going to be based on all the points, and hence this is 40 lakhs. I will allocate the total transaction price of 5,000 in the ratio of 5,000 is to 40, that is 5,000 by 5040 and 40 by 5040, and thereby get 4960 and 39.68. Your entry will still be the same, bank account debit 5,000 to sales 4960 to CLP liability 39.68. Now comes a bit of a challenge, and I would say a bit of controversy. If I were to solve till here, in my opinion, there is no problem. There is no problem over here. That same we have the institute has also solved considering the revised statement. Now, what happens next is we need to recognize a part of the revenue. Now, revenue should be based on the points that have been utilized. Now, a logical reading over here, in my understanding, would tell you that, well, if 18 lakh points remain undiscounted, that means maybe 82 lakh points must have been discounted. However, the institute does not treat it like that. The institute says that for every number, we are going to take 80%, and hence, if the total points awarded were 1 crore points, 80% of that, that is 80 lakhs, are expected to be redeemed. Perfect. So if your total points awarded were 1 crore, 80% of that expected to be redeemed is 80 lakhs. Now, we have been told that out of the total 1 crore, 18 lakhs remain undiscounted. Perfect. So this is undiscounted or yet to be redeemed, which means logically 82 lakhs in totality level would have been redeemed. Okay. Now, this is where I do have a bit of a problem with the treatment which is there in the institute. But again, at this stage, my opinion matters less. What the institute has done matters more. So over here, what they have done is, since the question tells you that everything is based on 80% of the total points, if 1 crore points were there, 80% of that, that is 80 lakhs, were expected to be redeemed. Similarly, if there are 18 lakh points outstanding, they say 82 lakh points would have been discounted now. Discounted would have been 82 lakhs. However, 80% of that would be redeemed. Now, I don't know the difference between discounted and redeemed personally, but this is how the institute has solved. So probably their interpretation is 1 crore points are in total, 18 lakhs remain undiscounted, so 82 lakhs were discounted, but whatever was discounted or remains undiscounted, 80% of that will be actually redeemed, or 80% of that will be expected to be redeemed, and as a result, 80 lakhs which are discounted into 80%, that is, I can say 65 lakh 60,000 points would have been redeemed. Now, this is a little difficult to logically reconcile, but at this point, you'll have to take that if a similar language comes. And out of the 18 lakh points which remain undiscounted, again, my expectation is that 80% of the points are going to be utilized. So 1 crore are the total points. I'll again repeat, out of that 80% of the points are expected to be utilized, that is redeemed. Out of the 1 crore, I can say 18 lakhs remain undiscounted, whatever that means, which means the remaining 82 lakhs were discounted. But what is redeemed is all considered by the institute as 80% of each of these points, and hence 80% of 82 lakhs as well as 80% of 18 lakhs is what you would say. So we will say that out of the 80 lakh points expected to be redeemed, 65 lakh 60 have been redeemed, and remaining 14 lakh 40 are expected to be redeemed. Are we clear with this? And hence, when they've recorded revenue, the ratio that they've taken is, well, they've said 39.38 was your CLP liability, which is for all the points which are expected to be redeemed, which is, by the way, 80 lakhs. And out of those 80 lakhs, we are saying 65 lakh 60,000 points are actually redeemed. And hence, 65 lakh 60 upon 80. So if I do the revenue, this is 39.68 into 65.60 upon 80, which will come to around 32.54. So these are your points which are redeemed out of the total points expected to be redeemed, and hence around 32.54 will be the revenue. Out of 39.38, if 39.32.54 is the revenue recognized, that is CLP liability account debit to revenue, the remaining will be your deferred income. That is 39.68 minus 32.54, and hence 7.514 lakhs. So this kind of takes care of your points A, B, and C. Even C is asking you to find deferred income, deferred revenue. Then you have point D. In the next year, that is 12-13, 60% of the expected outstanding points. Language dekho. 60% of the expected outstanding points. Sir, वैसे outstanding points were 18 lakhs. However, these are not expected. These are just outstanding. 18 lakhs into 80%. If I go to see, this will come to probably 14 lakh 40. So out of 14 lakh 40, 60% of the expected outstanding points were discounted. So over here, I will say 1440 into 60% will come to probably 8,64,000. So in this year, 8,64,000 points have been redeemed, and 40% of the outstanding are still remain outstanding. How much of the deferred revenue should the merchant recognize in the year 12-13, and what will be the balance of deferred revenue? So over here, the foolproof method would be to find what is the total revenue that should be recognized till date. Well, till date, earlier 64,60,000 points have been redeemed. Now 8 lakh 64 has been redeemed, and hence a total of, I believe, 73 lakh 24,000 points out of 80 lakhs are actually redeemed. So till date, देखो अगर अपन working देखे, your total revenue is 39.38, 39.68. Out of this 39.68, I can say, out of this 39.68, this is for 80 lakh points. Now out of that 64 या 65 क्या है? 65 lakh 60, my bad. Out of this 65 lakh 60 have already been redeemed in the first year. 8.64, if I'm not wrong, is redeemed in the second year. And hence 65 lakh 60 plus 8.64 will come to around 74 lakh 24,000. So this is a revenue that you should recognize till the second year. However, you have already recognized something earlier. And hence, this is the revenue recognized till date minus 32.54, which was earlier recognized, and hence the remaining will be recognized in the second year. So if I go to see, in the year 12-13, total outstanding points were 18 lakhs. Into 80%, this will give you the expected points. And redemption will be 60% of the expected outstanding points, and hence this is 864. Total points redeemed till date will be 7424 out of 80, and hence the revenue to be recognized would be 39.68 into 74 by 80, which is going to give you 36.82, out of which 32.54 was earlier recorded, and hence 4.28 will be recorded in the second year. Now earlier 7.14 बचा था, उसमें से I would say 4.28 will further be removed, and hence 2.86 I would say is a balance in the deferred income. Now whatever I've done in blue over here ना are the things which are the changes. So if you want to map up the changes, यहाँ पे ये पूरा board note देखो, उसमें जो भी मैंने blue में लिखा हुआ है, these are the changes with respect to the language that the institute has changed. Obviously उसके वजह से number change हो गए, but these are the relevant changes. And then last में, in the last year, as we discussed earlier, irrespective of how many points are redeemed, the CLP liability has to be made zero, and hence the balance in the CLP liability will be, which is 2.86, will have to be transferred to the revenue. So over here, these are the three main places where there is a difference, and I've tried to kind of, in a nutshell, in less than half an hour, try to bring you on speed with these differences and probably what you should do in the exam if such things come. So other than that, whatever you have studied, continue with that material. Don't really bother and try to reconcile other things. There may be some other cosmetic changes, but at a numerical level, at a concept level, beyond these three sums, you don't need to worry beyond for the other changes, if any, which are there. Just focus on these three and continue with the material that you have. Keep your faith momentum going, and you are almost there. You have given your best. You are doing a really great job. Keep your momentum going, work hard, and you're going to crack it. Okay, so I'll see you with more videos. If you need something else before your exams which you think might be helpful, please do drop that into the comments box, and if possible, I'll definitely try to quickly record a video in the shortest possible time and share it with you guys. Till then, keep studying, keep having faith in yourself, in a power which is stronger than all of us, and you're going to make it really good. Goodbye, good luck, and take care.